Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Seth Levine. Seth wears a lot of hats, but is best known as an author and most prominently as a partner at Foundry Group, a longtime early-stage firm investing in both startups and emerging fund managers. We talked about the art of working with founders, short-termism, knowing your own competitive advantage, why AI will create more jobs than it disrupts, and the myth of overnight success. Seth's new book, Capital Evolution, is great, which is why I'm sending copies to the first 10 listeners who want free ones. Just request them at investinginstartups.com/Seth. Terms and conditions apply, and it's US only, I'm afraid. I can't deal with the rules around this kind of thing in 50 plus countries, but we can do it in America, and so I am. I love this one. Seth is great, and I hope you enjoy. Seth, thanks so much for coming on the show.
Joe, thank you for having me. It's a pleasure to be here.
Yeah, this is going to be fun. I feel like you're someone we can cover a lot of ground with, and I've followed Foundry's work for a long time, so it's cool to actually talk shop.
Yeah, here we are. Exactly. I'm looking forward to some back and forth. Lots of stuff we can talk about.
I thought a fun place to start would be to talk about where you have the most fun at Foundry. Is that the direct investing, working with founders, or working with up-and-coming emerging managers on the venture fund partner side?
I love the question. I think about this all the time. I'm going to give you an answer that's a little bit different than maybe what you were expecting. We'll talk about this later, but Foundry is not going to raise other funds. So I've been spending some time thinking about, I'm not young, but I'm not like that old. And so I've been spending a lot of time thinking about what I want to do. And so but I'm trying to think about it through the lens of like, well, what am I really passionate about? What do I really enjoy doing? And I think the answer to that question is, I'll be curious if this resonates with you specifically, because obviously we do a lot of the same work, right? You're a GP as well. I really like doing deep collaborative work, right? So that could be with a GP where we're working through something very specific. Hey, they've got a secondary opportunity. Let's talk through the pros and cons of selling a lot or selling a little. Or maybe they've got some LP that's defaulted, and how do we manage that? I mean, all sorts of things you can imagine come up sort of with our GP relationships. And we often get those phone calls because we're also GPs, and so they relate to us. So, it could be that, or it could be working with a founder on any number of things that maybe relate to product, maybe relate to planning, maybe relate to some challenge that's going on, maybe relate to working on a sort of a longer term financial model. I mean, all sorts of things fall into that category. That's what really floats my boat. And so if you know something about venture, there's a lot of things that VCs do that don't fit in that category. And I think like one just obvious example, and it's kind of fun to rag on board meetings, but are board meetings, right? Because they often are not deep work, right? They often are just getting talked at. And, the sections of the board meetings I enjoy the most are either before the board meeting when maybe the CEO and I have breakfast and we sort of talk about the most important things, either ahead of time or right after, or, occasionally you do get into that a little bit, but I'm sort of giving you a contrast of those two things. But that's kind of how I define it. I really love, and by the way, I don't mind, and we will talk about the books I've written later, and those were a combination of deep collaborative work and just deep individual work. I don't mind deep individual work, but I particularly love deep collaborative work.
And how do you like to engage with the founders that you have? Is it more direct and organic, and the board piece is the more formal governance piece of those relationships?
Let me tell you how I do this, but I know the audience of the podcast, and I want to be careful that you're not doing it wrong if you are focused through your board work, for example. That tends not to be what I do. Now, I'm a very deliberate person. I spend a lot of time architecting. In fact, I think the next thing I'm going to write is about sort of I'm thinking about it as how to be more productive, but it's really about just how to supercharge your life and how to be more focused. And so I'm pretty deliberative with the CEOs I work with. Some of them I have scheduled one-on-ones, probably most of them I ultimately do. Some we just kind of catch up on the fly. Every CEO I work with closely gets an email from me every 6 months, beginning of the year and the middle of the year, where I say, hey, let's align on couple company goals. Here's what I think is most important for the business. And then let's align on areas where we might work together, right? Where can I be impactful? And I always tell CEOs, look, I work for you, not the other way around. So put me to work. Sometimes, to be clear, the what can we do together is stay out of the way, right? We, the company, are doing some stuff. I don't need to hear from you every week about what have you done with this? What have you, what we really, we know what we need to do. We've got some product level goals, but we know what those goals are. And I'm going to be in deep managing, getting stuff done mode. But oftentimes it's, a list of, again, I try to keep it to sort of 3 or fewer because I don't think you can be focused if you're not focused on only just a couple things, at least in terms of my interactions with them. But I try to be deliberate about, okay, what are we going to work on together? Now, it doesn't mean something can't pop up or they can't call me on something else. And one of the reasons I used to do it annually, and then I realized, and we realized really collaboratively, that stuff changed in the second half of the year in the same way that you kind of typically replan the second half of the year because you learned a bunch of stuff in the first half of the year. We kind of do the same thing for our work together. But I've found that, for me at least, to be an effective way to organize our work together. Because I want to, it's like the Hippocratic Oath, like first do no harm. And I feel like maybe it's just the time that I got into venture back in 2000, 2001. But I felt like VCs were so heavy-handed about the work. And I think that they thought they operated the business in some respects. And I'm like, kind of the opposite. I mean, I think venture is a great business, but I always describe it to people like I'm in the influence game, right? I make so few real decisions. So obviously, we make investment decisions. Those are the most consequential we make. We hire and fire CEOs, right? As boards, right? As a member of a board. That's not that frequent. And most other things, I mean, yeah, occasionally we got to vote for something, but most votes are relatively pro forma. And so the real work that you do, whether that's in a board meeting or outside of a board meeting, is you influence. A CEO approaches you with a problem, and it's not your decision to make, even if you have a really strong opinion. It's your job to describe your opinion and try to influence the CEO to do the thing that you think is the right thing for them to do.
Yeah, well, that resonates. And as someone who, my firm, we write collaborative checks. Our ownership's typically 1% to 2%.
Right.
I'm not in a position of showing up to a board meeting and throwing weight around, even if I wanted to. At the end of the day, it's about positively influencing and having a relationship with the founder. And if it comes down to, what's in the legal docs about my authority to affect change here, then the situation's probably already lost anyway and gone far off the rails.
And if it comes down to a board vote, it's probably in the same category. I'm not minimizing that. I mean, I've been in venture a long time. Like I've seen things come up to the board where we've had real disagreements that were legitimate. But at the end of the day, and I've stepped off of boards as well, right? Where, companies doing great. And I'm like, okay, we're good, right? You've got 3 late stage investors. Not that I haven't, I've been on boards all the way through IPOs. So it's not like I don't have that experience, but like sometimes I look around and I'm like, you're good. I don't need to be on the board for us to maintain the relationship. And I personally don't feel like I lose any influence by not being on the board. And I think that's something that LPs sometimes don't necessarily understand because they think that a lot more kind of operational level decisions happen at the board meeting. And some of those discussions are important. And by the way, you can get invited to board meetings even if you're not on the board. But oftentimes, what happens with the companies I'm not on the board of, for example, is that we will often meet after the board meeting and they will review with me some of the things that came up at the board meeting and say, hey, what's your opinion about this? And it's not that it's not, I'm happy to talk about my opinions in front of the rest of the board, but it does give me kind of a chance to like be the last voice in the room, if you will, and give opinions. But I'm rarely heavy-handed with my opinions, even frankly, if I have a strong opinion. Like my job is to support the CEO. Right. And to do that in a way that doesn't make them feel like they're backed into a corner. And I've found that if you are too prescriptive, more specifically too strong in your opinions about something, that they can often feel backed in the corner. And maybe, I feel a certain responsibility because we often are a relatively large investor. And I've been in venture a long time. So I recognize now that my voice carries in many rooms, that I need to be careful about not forcing a decision, because I actually really love debate and discussion, and I process information. I tell all my CEOs this. I process information through debate. Kind of drives my partners nuts because I'm always pushing on stuff, but we sort of come to, I don't know. I think they've come to love it. Maybe I'm deluding myself. But I think that process of like, hey, let's talk about the options. And I often need to take some time, right, to really think through something. I think oftentimes boards, I don't want to limit this just to VCs, boards and board members are too quick to like jump in with relatively little information about what they think a company should do. I don't know if that resonates. I know you've been in lots of, decision-making rooms and in board meetings as well, but that is often, at least what I've seen, to be kind of typical board behavior. And I like to take a beat. I'm rarely the first person to offer my opinion on something, so I want to think about it.
I have a meta question. So it sounds like you're very specific, targeted on working with your founders on prioritizing key things that you want to help them with and being very disciplined with it on that one-to-one and likely encouraging them, right, to just be really focused on what their key priorities are. When you have so many founders that you're working with and partners and stakeholders, like partner outside firms, but also your literal partners at Foundry,
Yep.
how do you personally go about your prioritization and kind of rank order of how you're going to dedicate your time and focus?
This is a topic that I'm super passionate about and is essentially part of it, at least. I haven't started working on it, but the next thing that I'm going to be working on from, writing a book, in part because I'm so passionate about it. And I've been giving sort of talks at some company retreats and things like that about productivity. And I would say two things, just sort of in response to that question specifically. The topic's much broader. The first is email is not my task manager. So like everyone, I get a lot of emails and I spend more time than I probably want to in my inbox, but I don't default to, when I have a free moment, go to my inbox and deal with it in, I guess, reverse order of what shows up, right? We all want to get to inbox zero. We start at the top, we work down. That's just a bad way to manage tasks. What I do is use a task manager. And then every morning I do a morning routine. I think a lot of people do a version of this. For me, it's I look at my calendar, I glance at my email typically, I don't do anything with it. I just see what's in there. And then I look at my calendar to remind me what I have coming up today. And then I go to my task manager and I write down as a task everything I think I need to do that day, personal or otherwise, or business. And then I order those things. And so when I have free time, I go back to the task manager and say, okay, what was the next thing I said I needed to do today? Could be review a board package, right? And sometimes things like that I'll actually schedule out on my calendar because that's a longer term, that's an hour of time, let's say. But it could be something like that. It could be, do the XYZ corporation analysis on whatever it was. It could be return these 3 phone calls, whatever it is. That ends up on my task manager. And so I try to manage myself that way. And it just keeps me from sort of defaulting to the I'll just go sit and email for an hour and then, see an hour's gone by and then I've gotten some email done, but I haven't gotten everything else done. What do you use for that, Joe?
I'm still trying to fine tune that myself. I'm guilty of letting email be my to-do list too often.
It's hard, right?
Yeah, it is. And it's easy to get sucked into. I'm a to-do lister. I use Google to keep up with different to-do lists and try and prioritize them literally in terms of importance. But next to my to-do list, like the actionable list, I have a list right next to that, which are my biggest firm priorities, like the biggest needle mover priorities to the firm. It's like, look, what are the things that if I truly impact, this is really going to affect change for everyone involved? And so at least I'm trying to keep it visually there, even if, I can find myself getting caught up and trying to get to the gamification of getting to inbox zero.
Well, I mean, hopefully the AI tools are getting better and better to help you maybe propose some drafts and things like that. I'm fortunate just because we've got a large enough sort of asset base, if you will, so management fee, that I do have an assistant and she does an inbox shadow.
You got an EA for the EA at this point.
Yeah, well, with the AI tools, it practically is. But that does help me, right? One of the reasons I stay out of my email is it's not very efficient for me to be working on my own email before Megan, who works for me. And before that, it was a guy named Micah who worked for me. He's the one who kind of came up with this. Before she goes through it and kind of gets everything prioritized. And I have a few different folders. For me, it's in Superhuman, but you can use whatever email you like. And she kind of guides me to the things I need to be spending time on. And then she takes a stab at writing a lot of responses for me. But again, AI is getting pretty good at this, right? So, I mean, I've played around with some of the Superhuman AI tools. Their search tool in AI is fantastic, but they also have some writing tools that are pretty good.
On the topic of maybe signal and prioritization, being a GP for a long time, you have your own depth of experience, but Foundry's been investing in outside firms for a long time and has really institutionalized the process of backing emerging managers, small funds. Is there a quality signal from GPs that you've learned the hard way over the years that you look for now that most emerging managers don't even realize they're broadcasting?
That's such an interesting question. I would say the real work of understanding what someone's not just thesis, but what's their real competitive advantage And a little bit of the philosophy of like, how do you want to run your firm? It's sort of the, you said you kind of have a couple of ideas on like, how do I really impact the trajectory of this firm and the underlying portfolio? I feel like you end up in these sort of an hour-long meeting where people go through the deck, their fund overview, and then you end up kind of doing some due diligence, and maybe you only met one partner, maybe you meet a couple others. And I think we used to sort of listen to those descriptions of how they had this unfair advantage and where they came from and why that informed what they do and sort of their instincts for investing, but didn't like really engage and go really deeply on that. And I think that that's the most important thing to me, right? Because it also from that, I mean, it gives you a lot of information in terms of like, what really are they interested in investing in? What is a firm deal for them? But it also gives you a lot of insight into just how they think and how they are as a person, right? And I think that that's almost more than anything, I think the indicator in the same way that we always say, we invest in people and teams and ideas. And we sometimes don't really, I think in the industry, have that lens when it comes to actually doing due diligence on funds. And I think Foundry is a little bit different in our way of doing this. I misunderstood the LP landscape when I first became a partner at a venture firm. And I thought that they had the same job that we have, right? They're making investments, but they're not, right? Most LPs are capital allocators. And that informs their worldview and the lens through which they do their analysis very differently, I think, than at least I had understood it to be. And I think one of the things that I'm trying not to do when we're evaluating funds at Foundry, or we're evaluating funds, we're not making new fund investments now because we'll talk about it in a sec, but we're kind of end-of-lifing. But one of the things that we were doing was trying not to just asset allocate, right? I got to fill in a couple of buckets. These guys seem like the most credible group for that. And I think there's way more of that happens in LP world than the kind of underwriting that I think the GPs listening to this do to companies and to teams in particular at companies, especially if you're a really early stage investor, because you're mostly underwriting the team, like the earlier you are. We try to do more of that. So hopefully that either makes sense or resonates.
Yeah, no, it does. It does.
There's a lot of funds. I'm going to diss on the Valley for a second. And we've invested in a lot of companies and funds in the Valley, but there's a lot of funds in the Valley sort of running around. It's like, it sounds great because they came from, XYZ company that was, they were ex-product managers from Google, Meta, OpenAI now, whatever. And they're going to do an AI focused thing. And they know it better than anyone else because we spent 5.5 minutes at OpenAI. And I think that they get too much credit for the pedigree. They're not asked to defend what are they really doing and what's their real insight. And they get funded, right? And I think core to our thesis is, of course, you can build a great venture fund anywhere. Joe, you're in Austin, I'm in Boulder. Those are just two examples of cities that are amazing places to build businesses. But also that people from different backgrounds can make great GPs, but there needs to be some real perspective. There's got to be something driving you in the same way that there's something driving, a company founder. And I think really sort of uncovering what that is and getting to drive, I think is really important.
You've said before that fund size is fund strategy. Can you maybe talk about a decision you've made or the team has made at Foundry or refused to make because you didn't want the firm to become a different kind of business?
Yeah, well, maybe the most obvious one is not kind of having a perpetual fund, right? We didn't do the kind of organizational planning, generational planning that you need to do. And that, again, it's not a knock on firms that do that, but it drives a very different type of behavior. And I think certainly from a personal perspective, I probably would have made more money that way. Not probably. I certainly would have made more money that way because you get to hang on to at least some residual economics for a longer period of time. But it wasn't the kind of work that we wanted to do. I mean, to be clear, right? We did toy around with it. We started the firm saying we're going to, the four of us who started it, we're going to run it till we're done and then we're going to be done. And then somewhere in the middle, we became a fund of funds and Lyndall and Chris Moody and Jacqueline Hester joined us. And we started flirting with the idea of like, well, maybe we will hand the reins over to them and they can kind of take it on. And I think ultimately we sort of came back to first principles and realized that wasn't going to work for a bunch of reasons. One of which is just like we had not from the beginning planned on that. And I think we would have done things differently had we been architecting ourselves to hand the reins over. But it also it was a little bit of sort of oil and water. Like it just wasn't who we were. And so that's an example of a decision that we made that could have driven a very, very different kind of fund strategy because of the decisions we would have needed to make to bring more people on and bring them up and do more firm building, if you will. So, I see a lot of firms sort of struggle with that. in lots of different ways. But ultimately, when I say fund size is fund strategy, what I primarily mean is that your fund size should dictate your investment strategy. And that's all the way from what stage you invest in to what your check size is to what your reserve policy looks like. And that doesn't mean that all those things have to be static. That can change fund to fund based on market conditions. But the number of people who I've seen, they're raising a $25 million fund, but they've got a $75 million hard cap. And you say, well, tell me the difference between closing on a $25 million fund in your strategy and $75 million fund in your strategy. And they're like, oh, it's just the same. We're going to just write $750,000 checks instead of $250,000 checks. And you're like, I don't know that that computes, right? I mean, within some bound, it makes sense. But at some point, your fund size has changed and therefore your strategy needs to change. How you approach the market, how you think about board representation or not, how you think about follow-on investing, all of that flows from what size platform do you have.
Are there any portfolio construction strategies or frameworks for running a fund that you feel like aren't explored as well as they could be?
I think there's two areas I'd point to. One is, I think, done really well by a firm called Arthur Ventures out of Minneapolis. They tend to specialize in B2B SaaS businesses that haven't really raised any money, gotten to $5 or $10 million worth of revenue, need a little bit more for expansion, and are kind of under the radar. And they built a very successful platform. We were fortunate enough to be investors. We were actually their first institutional investor. We basically, helped them institutionalize their fund. But that's a strategy that I think is really interesting. It's just different than what other people are doing because the types of businesses that they're looking at aren't the kinds of businesses that you or I might look at. And maybe it's more akin to almost like a PE strategy, but at a venture scale. And it's been wildly successful. It's been really successful. Another area that I've been talking to some people about, just some ideas around, are actually, and this may not be exactly what you were thinking about, but a bit of I want to call it a roll-up strategy for other venture funds. But there were a lot of funds that were raised in the 2019, 2020 timeframe that turned out to be not a great vintage, right? Because we were sort of peak ZERP at that point and kind of peak valuations. A lot of those funds got invested too quickly. But there are some underlying interesting assets in those funds, but they weren't big enough. The GPs were relying on the idea of raising the next fund. They could kind of float their lives for a couple of years, but at some point they needed to raise that next bigger fund or they weren't going to have management fees to actually support themselves. And so they're off trying to figure out how to get a job, right? How to do something else. But they also are still feeling like they have a responsibility to their LPs to continue to, of course, monitor and work with their portfolio companies. And there's a few people that are looking at some interesting strategies to kind of put all of those funds or a bunch of those funds under a single umbrella and allow GPs to maintain some of their economics, but obviously they're getting paid for a portion of those economics. That's another area. Again, I'm just thinking about like, what are people doing that are different than just the kind of day-to-day work that you and I do, which is like we look at companies, we decide to invest, we don't invest, maybe we invest with other people, maybe we don't. But fundamentally, it's about the same thing, right? You invest earlier than we do, you write different check sizes, but we do the same things. We look for interesting businesses, interesting teams, and we write them checks and, hope that they return us bigger piles of money. Fundamentally, it's pretty similar. So those are two examples of things that I've seen people doing that are maybe a little bit different than kind of what other people are doing in the industry. And I like that, right? I mean, I think there's great experimentation. I guess the third thing I should have thought about this because I was in Atlanta yesterday doing a book tour and I saw one of the partners of this fund, Jewel Burke-Solomon. But there are some funds that are kind of at the edge of venture that are doing these sort of quasi-venture style deals where they've got like some debt elements into it. It's like a revenue-based return plan, but they also have equity kickers in them. Indie VC kind of pioneered doing this. Bryce out in Salt Lake was the kind of first person to really do this at some sort of scale. And then Collaborative Fund, which is a Jules fund based out of Atlanta, which made me think about this because I just saw her, is also doing that. So those are some different style of investing that I think is great. Like I love the experimentation. I think that's really interesting.
If you were 20 years younger, starting a brand new firm and the clean sheet of paper, whatever contours you want on like size, pacing, portfolio construction, strategy, and you were optimizing for performance. So Ferrari model, purely for performance, not for asset gathering. What would that look like?
I'm going to answer the question two ways. So first, I'm going to give you the answer to the question that you really are asking. And then I'm going to give you a slightly off the wall answer. The question that you're really answering, I think the way to do that is it's funny, we had this debate when we started Foundry. I remember going out to dinner and we debated this. We all read and we had this strategy and we were going to make 25 to 30 investments. And this is much, we were going to hold whatever it was at the time, 50% for follow on and whatever. And we all read Nissim Taleb's Black Swan. I think maybe it had just come out, right? This is back in like 2006. And then we had dinner and we debated what were the lessons from the Black Swan about operating a venture firm. And I remember I was the outlier. Everyone was sort of like, we should do basically what we're going to do at Foundry. And maybe that was the right answer because we ended up, building a successful venture firm. But I was arguing, no, we'd make far more initial investments, right? The idea is very few companies actually do really, really well. And the better thing to do would be to make sizable enough investments that you had a little bit of ownership, right? It has to, again, fund size is fund strategy. So if it was going to be a $200 million fund, then it needed to be 225 in our case. We didn't know that at the time. We were going after 175, but pick 200 for round number. It's got to be enough that if you make a 20 or a 50x, that it actually matters to your fund. But my argument was like, I would do a bunch more investments per fund than sort of the typical fund model, right? Because concentration, I think people delude themselves, especially at the early stage. They can find the right companies and concentration matters. So that's probably what I would do. I'd be pretty cautious about my follow-on strategy. I don't know that I'd even have one, right? I think it might be like, look, if you need me for follow-on, then you didn't do well enough, right? So I think that's the answer to the question you were asking. The more off-the-wall answer is, I think I'd move to Saudi Arabia and start a Series A or a growth fund there. Because there's so much, I know that market a decent amount because I am an advisor to really the only Series A fund in Saudi. There's so much opportunity right now in those markets. Part of why I'm answering your question this way is I've said to too many people, if I was 30 years younger and didn't have a family and stuff like that, like I would just move to Saudi and do this. I think it's all sorts of challenges, right? But there's challenges everywhere. We've challenges here in the US as well. But there's so much opportunity in some of these frontier markets. And maybe that's just because I've been investing in the US for a long time and now I'm ready for a different challenge. So perhaps 30-year-old me would not think this way, but 53-year-old me thinks this way. So that's two different answers to your question. I think the first answer is what you were looking for. The second one was a little bit off the wall, but there will be people who are listening to this who have probably heard me say, if I was 30 and didn't have a family, I would move to Saudi Arabia because I think there's so much opportunity there.
I like both answers. I like the straight down the pike and the off the wall. They're both good.
It's good to surprise people, right? Keep people on their toes as they're listening. Hopefully no one drove into a, concrete barrier while they were driving and listening.
I want to talk to you about capital evolution.
Yeah.
You're super busy, a lot of balls in the air, as we talked about. And obviously, you need to be passionate to dive in and write a book on something when you have so many things going. Was there a specific spark or moment that inspired you to write the book?
Yeah, there absolutely was. But before I tell you what that was, let me just make a meta comment, which is like, for me, there's two types of activities, right? There are activities that suck energy and activities that give you energy. And writing, on balance, not every time I write, but on balance, is something that I find gives me energy. And specifically, my mind is a very crowded place that's very busy. It's really hard for me to like shut it down. I try meditating. I enjoy meditating, but it doesn't work in that way for me. I'm constantly like trying to bring myself back to center. And writing for me, actually, I find incredibly centering. And it's like one of the only things I do. I have a couple sports I do that kind of I can get in that flow as well, where I don't think about anything else when I get into that kind of flow writing state. And I think that's part of why I really enjoy writing, is because it's a quiet time in my brain, and I really appreciate that. So that's a general answer. The specific, because you're right, it's like I dedicated a lot of time to this. It's my second book. They take real time, and I take pride in the work that I do. And nothing wrong with the typical VC book where you sit down in front of your computer and you just think off the top of your head about stories that you have and talk about whatever your experiences. And those aren't easy to write either, but we interviewed 100 people for Capital Evolution. We reviewed, thousands of papers probably, right? Just like there was a lot of research, 2 years of research that went into before we even started really writing. A year and a half before we started, but 2 years in total of research. And then, a solid year of writing. What made me decide to write the book is I was at a board dinner actually in New York, and all the other board members had gone home because they were all locals and I was in from out of town. And it was just me and the management team. And one of the CEOs, we had a conversation about something that another CEO of ours had posted, about Dobbs and, sort of access to medical care for women. And people had sort of jumped on him from both sides, right? It didn't go far enough in one direction. It went too far. And he was sort of hearing it from everywhere. And this other CEO was saying to me, hey, would you accept a lower return for us living our values? And I hadn't really thought about it that way. I mean, obviously I said to him at the time, like, hey, and actually I believe this, I don't think you need to choose running a company that has a set of values with a lower return. But I think what he was saying, and this is back when sort of every company was being asked to like put out a statement about everything that was going on. And then that's what he was asking is like, hey, do we need to be like on the front lines on all this stuff? And it got me thinking about, well, what's the role of business in our society and in our economy? And that kind of spun me up. And I woke up thinking about it. I called Elizabeth a couple of days later, my writing partner, and I said, hey, this is pretty interesting. We talked about it. We did a couple just interviews for fun, like people that we knew we thought would have an interesting opinion about this. That was kind of Elizabeth's idea. She's a reporter, so that's kind of where her head goes. And so we got some interesting feedback, and we were like, the question of business and the businesses and a business's role in our society is interesting. And two, there's a larger story here about kind of the changing nature of our capitalist system that feels like, and this was like 3.5 years ago, feels like there's an interesting story to be told here. And so that's why we decided to write it up. So we ended up doing a bunch of preliminary interviews, and then we wrote that up and sent it to, we have an agent because we'd already written a first book. And she was like all over it, was like, this is amazing. I freaking love this idea. And so we did not want to work with our existing publisher. So we shopped it around and another publisher picked it up for us. And we were kind of off the races on it.
I mean, obviously you go into a book like that with some initial hypothesis, but then you go out and you talk to 100 different people, doing 100 different interviews. You're also genuinely curious and you're not just going through the motions to have all those conversations. Were there moments or insights from all those conversations that tilted maybe where you came in to doing the book, that initially you had a point of view and you had all those conversations and thought, you know what, maybe this part or this aspect's different than I expected?
Yeah. I mean, the very basic question that was initially posed to me, right, which is sort of like, should companies speak up about things that are happening in our society? And I was on the yes side of that, right? And by the way, I think there's a real debate to be had. So I'm not saying that, what I'm about to say is right. But after a bunch of interviews, including people who were like, absolutely, Dan Schulman, who's now the CEO of Verizon, he was very vocal about, hey, we need to talk about everything that comes up. And I don't mind doing that. He got death threats and things like that for some things he said at PayPal. But, that was his view. Obviously, it didn't stop him from getting the job at Verizon, right, which is a sort of 10x bigger company than PayPal, versus like Jamie Dimon from JP Morgan. We got to spend time with him. And, he had a very different take about sort of the line between values, expressing your values as a business, which he was a proponent of and writes about, versus like being overtly political, being weaponized, to use his phrasing. And it actually made me, and I mean, again, dozens of other interviews with other CEOs and by the way, other people that work at various levels in companies, private companies, public companies, et cetera. And it actually made me think differently about that. And the conclusion in the book is like, actually, we don't necessarily want to live in a society where every company is identified by their politics and every issue that happens, we expect CEOs to be jumping up and down and sort of talking about it, right? I mean, very famously in the middle of all of this, Brian from Coinbase came out and said, hey, we're not going to do this at Coinbase, right? And I remember at the time, this was before I'd gone through all of these interviews, and I remember at the time thinking like, I don't know that I agree with that actually.
And there was a lot of blowback for that.
But there was a huge amount. Yeah. So you remember that. But I think fundamentally he was 100% right. I think he was like, look, we have values, we care about our employees, et cetera, but like, I'm not going to raise my hand and say this proposed law in New York, even though we're in New York, is good or bad, or this thing that is happening with the Biden administration, the Trump administration, I agree with or I don't agree with. I think it's interesting that he was out so early. I give him a lot of credit for just being out. Interesting, of course, that he got a bunch of blowback, but then didn't change his mind, right? He didn't bow to the pressure, if you will. I give him a ton of credit for making a statement and sticking to it. And I think he was right. And again, that's my view. And other people have different views. And guess what? If you found a business and you're the main shareholder or whatever, like, yeah, you can do whatever you want. In the same way that, Yvonne Chouinard and the Chouinard family has a very different view about how political their organization should be than other companies. But by the way, Hobby Lobby has a similar view, also a closely held corporation. I mean, they're free to do whatever they want because they're sort of tightly held, but I don't know that we want public companies or any companies really running around, or every company running around doing that.
Yeah. I think having an opinion on everything, like I don't have an opinion on everything in real life, like outside of
Right.
work. I don't go around espousing my opinion on everything in every conversation. 5-ish years ago, I was chief investment officer at a firm around Australia called Lake House Capital. And I was talking to a consultant who was vetting us, as potential investment. And I got a question about our modern slavery policy. And I was just totally confused because we're a firm that largely invests in software. And I was confused. I'm like, I'm sorry, is the question, are we against modern slavery? And they're like, no, no, like, can you tell me about your policy? And I'm like, we're against it. We do not have a policy.
Yeah, we haven't written
This
that
really
down, but
specifically addressing, like, we're definitely against it. And I was just kind of blown back at the time. And I kind of laughed it off. And our sales team afterward in distribution was like, we probably do need a policy for this. I'm like, look,
wow.
again, reinforcing I'm against it, but we largely invest in software and tech companies. And why do we need a policy talking about why we're against this? Like I'm against murder and a variety of other things that are really
Right.
terrible that we could
I'm
probably
for
all
gravity. Like, do we
yeah,
need to say
for
that
gravity.
too? Right? Like,
But we ended up with policy, and I was like, look, fine. I'm
yeah.
not going to say no. I mean, I'm not going to say no to saying we're against it. So if you want to draft the policy, I'm fine with it. But it felt like a jump the shark moment.
I love that story. Thank you for sharing that, Joe. And I really do feel like that has sort of pervaded, or at least it did for a while, a lot of spaces in our world. And I think that is in part responsible for this like massive blowback that we've had, and sort of in part responsible for our fractured politics, right? Where we force like random context, like not at all related to what we're doing or talking about. But yeah, like let me reaffirm for you that we are against slavery.
I went along with doing the policy.
Yeah.
So,
Well, because you felt like you had to, absolutely.
yeah,
And
more or
I
less.
think that's in part why ESG maybe got a bit of a bad rap, because there were things like that just felt incredibly pro forma and not at all related to questions of like, how do you actually operate your business, and questions that are relevant to that. So frankly, I think we went down that path to our peril, because I think that's what created the blowback. And of course, like everything, the pendulum always swings too hard, right? So the blowback was too much. And, we're living with the consequences of that, certainly in the US, but in a lot of places.
Well, great segue into kind of short-termism in general.
Yeah.
But to go back to short-termism, and it comes up in the book and a critique of it in relation to capitalism. Can you talk about where you've experienced pressure, again, kind of on the short-term side, either from founders or investors, where and there's been this pressure to pursue a short-term easy win at the expense of trying to build something bigger or more lasting?
So first, let me just frame the book for 2 seconds, right? Which is Capital Evolution, which is the name of the book, really sort of describes a potential future for capitalism, right? And it's a bit of a defense of capitalism. It's probably more so. It serves that purpose today than maybe I thought it would need to when we started writing it 3 years ago. But I think that's important. But it also talks about how has capitalism been organized for the last 50 years under neoliberalism, sort of Milton Friedman's vision of shareholder primacy. Shareholders are the only thing that matters, versus, and I think we've kind of already moved away from that. Business Roundtable in 2019 came out with a statement on sort of what companies should care about. It included other constituents other than shareholders. And of course, all good CEOs already care about things like employees, suppliers. Hopefully the good ones also care about things like the environment, et cetera. And so the book talks about and describes sort of a potential next chapter of capitalism. It's not that radically different than where we are, but it is different in some important ways. So I want to just kind of frame that. The short-termism, and one of the key pillars of what we call dynamic capitalism, which is the term we use to describe the next phase of capitalism. One of the key pillars is medium to long-term thinking versus short-term thinking. Neoliberalism really forced companies to think quarter to quarter, much to their detriment, by the way. The average half-life of Fortune 500 company is 20 years. So it's not like they're doing a particularly good job of perpetuating themselves. That's probably good, right? I actually think that dynamism in our economy is helpful. And our economy is actually quite a bit less dynamic than it used to be. And there's an entire chapter in the book that describes this and calls for an increase in dynamism and talks about how we can do that. But the most obvious example, and I think this comes up all the time, and it's almost implied in the framing that you gave in your question, is like, should we sell the company now We're sitting here in 2026. DPI is pretty hard to come by. Most of our investors would love a little bit of DPI. What's the trade-off between selling one of our best assets today? I mean, selling, not taking a little off the table in a secondary to cost manager basis or whatever it is. I mean, sell the company or keep going because you really believe in it. And I think that is the version of this question that I think VCs face most often. And I think the biggest mistake that they often make is not being clear about whether they're wearing their venture hat, their GP hat, or their company board member hat if you are also on the board. But I do see people chasing deals, chasing liquidity and DPI, at the expense of longer term. But I get it, right? Our investors, I hear from investors all the time, hey, more liquidity is better than less. Why did you sell, 10 or we often, if we can, sell a little bit of some companies just to, get our cost basis or a multiple of that off the table and let the rest of it ride, especially if we think the valuation's attractive to do that. And so that's probably the most obvious example of that. Companies, I think, do this all the time when they ignore for too long sort of core underlying metrics. I've always been sort of a fundamentals person. Maybe this comes from having been in investment banking. I've analyzed a lot of businesses, but I really care a lot about your core metrics and whether or not they make sense. And I think a lot of companies and some number of VCs ignore that stuff and they just focus on, can you just raise more and more money and we'll just spend more and spend faster? And every once in a while that works, right? You see these companies where they just spend like crazy, they grow, and someone is like, oh my God, I have to own that. And they pay an absurd amount for it. More often than not, I think it doesn't work. And so that's why, I'm a unit economics guy. And I often will say to companies, look, we need to have an eye on unit economics. That doesn't mean that you can't sometimes maybe push your CAC payback period out a little bit because you're trying to grow or there's some network benefit to growing faster. And it's not that we don't have any companies that are burning a decent amount because they've been able to raise a bunch and we're trying to capture market share. There are reasons to do that within reason, but I've watched lots of companies go crazy on that. And more often than not every time, more often than not, it doesn't work. That I think is another example of what you're describing, which is people sort of not thinking to the long term and thinking just to the short term, right? And then, look, VCs think whatever's happening at that moment is what perpetuates, which is part of my frustration with the venture industry. And so if everyone's investing, and this happened again in 2019, 2020, like plow your money in, right? Like, let's get going. And that's often the worst time to be investing, right? And on the flip side, if the markets look really frothy and valuations are way down, people are like, don't invest, hold on to your capital. We should let the market settle out. And oftentimes that's the best time to be investing, right? And so those are other examples, I think, of the phenomena that you're kind of getting at in the question. Does that resonate?
Yeah, it does.
Yeah.
How do you think about AI in the context of enabling entrepreneurship?
I am very long-term bullish. And I would say, one, I'm someone who defines entrepreneurship very broadly. So I think it's important to say when I'm answering that question, I'm very explicitly not just saying, I think that AI will be great for tech companies and tech-related companies. Like I ultimately think AI will be great for all sorts of Main Street businesses, new builder businesses, to crib from the language of my last book, right, 2 books ago. I'm very long-term positive. I also believe that it will be very short-term disruptive. And I don't know exactly how. And I'm a techno-optimist just in general. I imagine you are as well, just given our jobs, right? We sort of have to believe we're doing good in the world, I guess. Otherwise, it's hard to sleep at night. But I definitely believe that AI probably is the most transformational technology change that I will have lived through in my life, certainly in my investment life. And that makes me really excited about the possibilities. But I also believe it will be very, very disruptive in lots of ways that we don't understand yet. And I always tell people let's take a beat for a second, right? Like we're not even at the first inning, like the first batter is up, to use the sports analogy. Like we're just barely getting started. There's a lot more we need to understand. That's why I'm cautious about AI regulation. I'm sitting here in Colorado. We're doing stupid things around AI, which I think don't make sense. Texas actually has a much better stance to this. And it's not that I don't think that AI should be identified when it's being used and there can't be any regulation. I'd rather see it be federal, but I think there can be some, but I don't want to go crazy on it because we got to give it some time to breathe and get going. But we also need to learn from some of the mistakes we made, for example, when we outsourced manufacturing and gutted our blue collar economy, especially in the Rust Belt, and be thoughtful about what happens when AI disrupts a bunch of jobs. I actually believe this is happening a little bit. Like, AI is a great sort of convenient excuse when you want to fire a bunch of workers and you're a 150,000 person firm. So it's convenient. And I think a lot of CEOs are sort of like, kind of like, yeah, no, hey, we're much more efficient. And everyone hears that and they're like, oh my God, they're employing AI and they're firing 10,000 people. No, they're firing 10,000 people because they've got a bunch of middle managers and they're inefficient. And so I think that you've got to like listen to what's happening through that lens. I think AI will create far more jobs than ultimately it disrupts, but they may be somewhat different jobs, right? And we know you need to actually be much more deliberate than we often, at least were back in the 90s, about doing retraining and sort of helping people out and sort of how do you bridge from one job to the next. But I that's my general view of kind of how things are going to play out. I think AI is probably already creating more jobs than it's disrupting. It's allowing companies to be more efficient and more effective. And by the way, if you care and know anything about our economy and the debt and deficit and things like that, like, we can either default. I mean, if we're going to deal with our debt, we can default on it. That sounds terrible. We can inflate our way out of it. Probably fine for you and me, but because we're asset holders, but not so great for the vast majority of society. So that doesn't sound good. The only other thing we can do is grow out of it, right? Is be more productive. And so I think AI has the potential to help us materially fix this, what I believe to be the biggest sort of existential threat to our economy and sort of everything about our way of life, which is this ballooning debt. And we're, close to this kind of debt spiral. We got to find a way to grow out of that, or we're going to inflate our way out of it. And that's going to be terrible. How do you feel about AI? Like, what do you tell your friends or your parents or whatever about AI's impact?
So generally, very optimistic. A couple weeks ago, we had some friends over who work in tech, and I was surprised at how negative they were on AI. So one of them particularly had really concerned views around data center environmental impacts, for example. And another just felt like AI wasn't all that useful. And it was a bit of a splash of cold water for me because I realized a little bit, I'm like, I'm spending all my time talking to founders and other VCs who are kind of at the bleeding edge of this stuff. And granted, maybe we're able to see where a lot of this technology is going and the empowerment enablement that comes with it. But it was a stark reminder of, oh, right. Like, I'm not sitting here having like a mainstream view. Even though being super bullish on AI is very consensus within venture, I saw a study the other day that Slack said like 40% of American workers haven't used AI at all. And like only 20% of them use it daily. And I'm guessing you and I are, I'm assuming, probably power users and come up with all kinds of different ways to put it to work, but we're not representative of that. I think there'll probably be a lot of speed bumps along the way in terms of society. Politically, there will be plenty of hot potatoes thrown around. But something I am really optimistic about is the enablement piece, and one that you've probably known for a long time and I think has been widely discussed is, so code generation, for example. It's like, okay, look, if it's easier for people to develop code and build, then that's going to unleash more innovation. And that's something people have said for a while, but I saw like the first real data point that made me do the once upon a time in Hollywood point at the screen, like, Leonardo DiCaprio, like, yes, like that, where the number of new apps published to the App Store has aggressively started moving up in the last few months. And it had actually been going downward in terms of like the net number year on year. And it was going backwards because the App Store is pretty stale and the people winning continue to win largely. But just seeing that really start to move up and to the right, I felt was heartening. And it was great to think about all the people out there building something who are, have a go. And I feel like we're still pretty early on that being understood and the capabilities of tools enabling that.
There's two things you said that really resonate in particular with me. One is this idea of like, get out of the bubble, right? I mean, one of the real pleasures of writing the book and doing the research that we did is I got to talk to people that had a lot of different views. When I was very, very early in venture, like my first or second year, I remember a partner, I was an associate at the time, and a partner at another venture firm said to me, "This isn't America." What he meant was what you just said, like the venture world is a bubble, meaning a bubble ecosystem, self-contained ecosystem, and it is not representative of the best of the rest of the world. And that always kind of stuck with me is like, we've got to listen to other voices. And so this was thing two, and like really appreciate other people's perspectives, right? And I think that it's important I think I at times can be dismissive of perspectives that aren't, I think everyone is like this, like that are not my own. I've tried to get a lot better about exposing myself to other views, but also like listening and taking it seriously, right? Like it's easy to dismiss some people that have views that you completely disagree with, or maybe are anathema to your worldview. But when enough people are saying those things, I think it's really important to at least try to listen and understand. And I think we run the risk in the tech world of just sort of whitewashing, like AI is amazing. If you don't believe that, then you're just fucking stupid and, you don't know what you're doing and whatever. And like, that doesn't help anyone. And that's not, by the way, you're not being a good proponent of AI by saying that, right? Like, I think you want to listen and be like, first thing I often say to people, if I'm in a more mixed group, is like, however you're using AI, you're not behind, right? Everyone's heard stories about people using AI for crazy things, but most people aren't using it for that at all. To your point about the Slack survey, right? I mean, most people are barely scratching the surface. They're using it maybe like search, essentially, right? Find some information a little faster, right? You Google something, you read the Gemini summary, and you're like, okay, now I've used AI. But I think it's important for people to understand that, like, hey, you're not using it wrong, and most people aren't using it that deeply. So let's talk about, like, what are you trying to do? Let me help you try to figure out whether you can use AI more efficiently and better. Because I've loved it, right? I mean, it's definitely made me more efficient in a lot of different ways. And some of that has allowed me to do more work. And some of that's like, I get more free time sometimes, right? Where I get through my work a little bit faster. I don't have to always put that into working more hours. Sometimes or working harder. I sometimes put that into taking a walk, right? Or going for a bike ride or something like that.
This has been really fun. I want to wrap up with one of my favorite questions. I ask it of everyone at the end of the show. What's a conventional view in venture do you think is bullshit?
I actually wrote an entire blog post. It was like probably 2012. The title of the blog post was, I'm getting sick of the bullshit. And what I was describing was this mentality of like, the goal is raising more money. The goal is going to the party. The goal is like being seen places. The goal is your collection of hoodies from all these interesting businesses, right? That people have heard of. The goal is looking cool at the cocktail party. And I think the conventional wisdom inside a venture is like, that shit matters. And I don't think any of that matters. And the thing that's related to that, one of the other blog posts I wrote that was sort of that one got a ton of play. One of the other ones I wrote maybe a little bit after that was, I called it the 10-year entrepreneur. And when you read the venture press, you kind of have the idea that like companies are successful all the time. It's all easy. It's like all these businesses are up to the right. And it's just not like that, right? Everything is a sausage factory. It's really messy, right? I can only imagine what's going on in whatever, Anthropic or OpenAI or whatever. And yeah, I mean, good for you if you got in early in one of those businesses. Like, I think you'll do great. But I think it's important for entrepreneurs who are listening, and for VCs for that matter, like, you can constantly be thinking like, everyone's being successful except for me. And that was why I think that post resonated, because I talked about how like the overnight successes usually have years and years and years of hard work behind them. It's never written about that way, right? And I think it's bullshit when we pretend like all these businesses were like somehow an overnight success. Like, people toiled away for years and years trying to get them to be successful. And then all of a sudden it gets written up in VentureBeat or whatever it is, and everyone now knows about it. But they don't really talk about the 6 years that went into getting to that point where you could have that success. And I think those two things kind of, to me, go hand in hand.
Seth, I've loved this conversation. It's been super fun. Thanks so much for coming on.
This has been really, really a great discussion, Joe. I really appreciate it. Thanks for having me.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai, and thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.